All right, let's talk about the stock market. It seems like this huge, super complicated thing that's only for Wall Street types, right? But what if I told you the whole idea started with risky sea voyages and a bunch of people hanging out in coffee houses? Today, we're going to pull back the curtain on the market, tracing it all the way from its wild beginnings to the app that might be on your phone right now.
So picture this. We're in the 1600s. The Dutch East India Company is this absolute giant. We're talking hundreds of ships sailing all over the world, trading for gold, spices, silk, you name it. It was a massive operation, truly on a scale the world had never seen before.
But they had a pretty major problem. These trips were unbelievably expensive. And not just that, they were incredibly risky. I mean, one bad storm or a run-in with pirates could sink a ship, and poof, the entire investment would go right down to the bottom of the sea. So the big question was, how could they possibly afford to fund something so huge and so dangerous?
Well, their solution was, honestly, brilliant. They went straight to regular people, to private citizens, and made them a deal. They said, hey, help us pay for this voyage, and if the ship comes back safely, you'll get a piece of the profits. We call that piece a share. It was a genius way to spread out the risk while also sharing the potential reward. And it was right there, in these bustling coffee houses and busy shipping ports, where people started buying and selling these shares that the Dutch East India Company, totally by accident, mind you, invented the world's very first stock market.
Okay, so let's fast forward a few hundred years. The basic idea is exactly the same, but, the process is a little more official now. Let's imagine a brand new coffee company wants to expand. How do they take that same idea from the 1600s and use it to grow their business today? Well, they go through a process called an IPO. First, our little coffee company shows its business plan to some big-time investors. And if those investors like what they see, they agree to sponsor the company's initial public offering. That's the moment the company officially launches onto the public market, where literally anyone, you, me, your neighbor, can buy a small piece of it.
So, you can think of an IPO as a company's big coming-out party. It's the moment it goes from being a private business to a public one. And that allows its ownership to be split up among thousands and thousands of investors through things we call stocks. And this is a really key thing to get. When you buy a stock in that coffee company, you're not just placing a bet on it. You are actually becoming a partial owner of that business. Your money is what helps them grow. It helps them open new stores, invent new drinks, and expand their operations. Okay, so now you own a stock, but why on earth does its price go up one day and down the next just like a seesaw? Well, it all boils down to two really simple but super powerful forces: supply and demand. It really does work just like a seesaw. If our coffee company is doing great, making more money, getting rave reviews, more people are going to want to buy its stock. So demand goes up, and that pushes the price up. But if the opposite happens, if people start to get worried about the company's future, they start selling their stocks. Demand falls, and, you guessed it, the price drops. And that selling happens because investors who think the stock's value is about to go down want to get out. They're trying to lock in whatever profit they've made, or maybe just cut their losses before that price falls any further. But what is it that makes people feel so confident or so worried in the first place? This is where things get a little chaotic, because a stock's price is influenced by so much more than just a company's profit report. I mean, just look at all these different factors. It could be anything. The price of coffee beans could go up. There could be a big change in the company's leadership. Maybe they get some bad press. A new competitor enters the scene, or even big picture stuff like new trade laws. All of this creates this constant noise in the market. And this leads to a really fascinating psychological twist. In the stock market, perception often becomes reality. If a company just appears like it's losing value, that can be enough to trigger a huge wave of selling from nervous investors, which then causes the company to lose actual value. It's like a self-fulfilling prophecy. This quote just nails it perfectly. The entire system, from massive economic booms all the way down to devastating financial crises, can be set in motion by something you can't even touch: human confidence. It's a market that runs on numbers, for sure, but also on emotion.
So after hearing about all this risk and chaos, you might be thinking, okay, this is probably a game that's best left to the experts. But here's the thing. In the last couple of decades, something has completely changed the game. And here's the bottom line. The stock market is no longer some exclusive club that's only for the rich and powerful. Seriously, that world is pretty much gone. So what changed everything? The internet. The internet completely democratized the whole system. Right now, with just a few taps on your screen,
any everyday investor can buy and sell stocks using the exact same tools as some huge investment firm on Wall Street.
And what that means is that today, anyone can get involved. You can put your money into companies that you actually believe in, and by doing that, you can work towards your own financial goals, whatever those might be.
So what started as a simple plan to fund some ships back in the 1600s has turned into this massive global system, driven by data, psychology, and technology. And it's more accessible than it has ever been before. Which really just leaves us with one last thought. Now that you know how it all works, what's an idea that you would invest in?